Welcome to Unleash Your Retirement with David Koren from RVA Wealth Management. Our podcast is all about providing anyone considering retirement with the confidence they need to pursue their dreams in this new phase of life. We cover a wide range of topics, from retirement planning to investing with purpose, all while making you laugh and keeping things lighthearted. With David's years of experience and guest industry leaders to help guide us, you'll walk away feeling informed, empowered, and ready to take on your future with confidence. So sit back, relax, and get ready to join us on this journey to a new life.
Hello and welcome to the Unleash Your Retirement podcast with your host, David Koren. I'm Wendy McConnell. Hi, David. How you feeling today?
Outstanding, Wendy. It's good to be here and have another opportunity to talk about financial issues. And today we're talking about something I think is a lot of fun. It's 529s. And because we're talking about that topic, I've asked Caleb Vaughan to join me today because he's our resident in-house 529 expert.
All right. Well, welcome, Caleb, and thank you for being here today.
Thank you for having me back on the show.
How do you feel being called an expert? I mean, do you feel the pressure or are you like, no, I am the expert. I got this.
I'm a guy with information. I don't know if I'm an expert, but I'll be happy to share with you what we've got here. And hopefully we can get some nuggets of wisdom in for people and clarify any questions that people might have on 529 plans because they can be complicated.
And there's a lot of misconceptions out there about 529 plans. I mean, most people think, oh, well, that means I'm locked into going to college in the state, right? No,
you can take a 529 plan to any state. It's not the same as what we're typically known or historically known as the prepaid education programs. It's not a prepaid tuition program. It's truly an investment account.
So why don't we start with what exactly a 529 is?
Sure.
Yeah. So a 529 is simply a tax-deferred savings or investment account where the growth is tax-free if it's used for qualified education costs.
Very
okay. So how do we go about picking the right plan? Is there just one or are there numerous?
Plans are typically sponsored by the states. And so Virginia, for example, where we're located, has two plans. It has the Virginia 529 plan, which is a more direct offering from the state of Virginia, and then the College America 529, which is an offering through American funds. And that's typically offered through financial advisors.
Okay. And what about expenses?
The Virginia 529 plan does have expenses. They generally are pretty low. Most of the investment options on Virginia's 529 offering are index funds. They do have some active solutions as well, but the key there is it's self-directed, whereas the College America program is going to be perhaps a little more expensive, and there's generally a front-end sales charge to purchase into the funds, but you're getting full service support from advisors. So either option can be good and appropriate for different types of investors who are looking for either full service or lower cost, but self-directed.
Right. And a lot of people like to do the self-directed approach because they avoid that upfront charge that applies to those. We have to use these commission-based funds that are available through American funds. And so we often tell, hey, if you go direct, you avoid that upfront fee, but, then you're in charge. We don't have any view. We can't see what's going on. We might give you some ideas about how you might invest, but you're on your own in terms of investing. Whereas if you do it with American funds, there is that fund fee, but then you're getting our guidance. We're making those selections for you. And we can help with servicing too, which sometimes is a big deal because, you have to be able to access the funds to get the money to the student once they are in college and make sure that what you're sending the money out for is something that's qualified in terms of a benefit.
I assume there are a bevy of benefits.
The big benefit is that tax deferral and tax-free growth if the funds are used for qualified education expenses. That's the main benefit. In addition to that, in some states, and Virginia is one of those states, you get some state income tax benefits. So in Virginia, you can deduct your contributions against your state income taxes, up to $4,000 per year, per beneficiary, per account. Now, all of those pers add up because each time you choose a different investment option, the College America and Virginia 529 plan generally create a new account number for each investment option. So each mutual fund at College America would get, if you had several for one beneficiary, would have different account numbers. Well, each of those is potentially subject to its own $4,000 annual deduction limit. So you could stack those up and deduct a pretty large amount in 1 year. And even if you contribute more than you can deduct, you can carry it forward to the future.
Yeah, and state taxes in many states like Virginia is a big deal. I mean, it can be a sizable benefit to have that deduction for the 529 for many folks. And I believe, if I'm not mistaken, because we do a lot of 529s for grandchildren. So it's the grandparents that are funding them, and they have a special exemption on that, don't they, Caleb, if I remember correctly?
Yep. So the $4,000 annual limit per account is for people under age 70, contributors under age 70. If you're over age 70 and you're contributing to a 529, you actually don't have that limit. You can deduct an unlimited amount in any given year.
And that can be a big deal if they're over 70. I mean, especially they could completely fund grandchild's education with one fell swoop if they want to and get that tax deduction.
They can. In fact, there's a rule we'll get into a little bit where you can accelerate your giving in a pretty material manner.
What's that rule? We going to jump to it?
We can get ahead and go right to that. So there's an $18,000 annual gift exclusion limit per individual, $36,000 for couples if they choose to do something called gift splitting. You can front load or super fund a 529 plan. And basically what that is, you're giving 5 years worth of gifts all at once. And so if you give more than the annual limit of 18 for an individual or 36 for a couple, you can elect to take this 5-year election, and it spreads out the contribution evenly over 5 years. It's as if you gave, instead of 50,000 all at once, it's as if you gave 10,000 a year for 5 years. And so then it doesn't trigger gift tax issues because you're keeping under that $18,000 annual limit.
Great. But I do want to I'll throw one caveat out there too, because on that gift tax limit, we are talking about estate taxes, and most people are not subject to estate taxes right now under current law, but that could change. So it may become a really big deal in 2026 when the estate tax limitations drop so much. So it will be an interesting play that.
So how do we get started? How do we go about opening a 529 plan and then, managing it?
So for the Virginia 529, you simply go to virginia529.com. It walks you through, you tell them you want to open an account, and you follow the steps on their website to do so. For the College American Funds 529 plan, if that's the route you want to go, you can contact a financial advisor like us to get started with that, and they'll walk you through the process.
Yeah. And I believe part of the process, the information they do need to know is the beneficiaries. In other words, the student's name and social security information, that kind of stuff needs to be available when they do sign them up. So they do need to know something about the person who's going to be benefiting from the plan, but most people would have that information, I would think.
I may be jumping ahead here, but what happens if the child decides not to go to school?
That's a good one.
A new rule was passed with the Secure Act 2.0, where you can actually take unused balances, and there's some rules around how it's used. So for example, the account has to be at least 15 years old, and the contributions that you're rolling over have to be at least 5 years old. But there's a rule now where the beneficiary can take up to $35,000 during their lifetime from a 529 plan and use that money to make Roth IRA contributions. It's a direct rollover from the 529 to the Roth, and they have to be eligible to otherwise contribute to a Roth IRA. It avoids the typical issues that you would have for making non-qualified distributions from a 529 plan.
And that's huge, because basically the money that went into the 529 and grew has never been taxed, right? And now you get this opportunity, because if you were to just take the money out, you'd have to pay tax on it. And I think there's a little bit of a penalty too for taking it out.
So the way that works with the penalty is if you have money left in a 529 and you don't have a qualified education expense to use it against, you can change the beneficiary, which we didn't talk about yet.
Right.
And there are ways to change the beneficiary that avoid tax implications as well. So that's an option. If you want to keep it for the same beneficiary, you can draw the money out, or the beneficiary can draw the money out, and whoever receives the money pays tax on the growth at ordinary income tax rates plus a 10% penalty.
But if you move that money directly into a Roth, Now you don't pay tax. There's no penalty on that movement. So you just take it from the 529, put it into the Roth. And guess what? The beauty of that Roth is that it's going to grow tax free. So when you go to take that money out later on, because you've got to follow the rules, 59 and a half, there's a lot of rules around the Roth, but as long as you follow them, that money then becomes tax free forever, basically, to the student. So it's a fantastic way to give, to transfer assets. And the one thing that Caleb didn't mention, so the other thing that can happen is, let's say this grandchild that you'd set the account up for decided they didn't want to go to college. Well, you have the option of actually taking those funds and moving them over to another grandchild, for instance.
There's a specific list of beneficiaries who are qualified beneficiaries for this type of rollover and transfer. So it could be transferred to a different beneficiary that is the current beneficiary's spouse, in-laws, their children, including stepchildren, foster children, or adopted children. It could be siblings of that beneficiary or step siblings of that beneficiary. Could be their nieces and nephews, their aunts and uncles, which seems like an unlikely scenario. It could also be first cousins. There's a pretty expansive list of qualified beneficiaries that the money could be transferred to, but it isn't all inclusive.
So now you're in this position where, okay, this grandchild didn't want to go to college, but this one over here really wants to go to college and they want to go to expensive school. I'll just transfer the money over here. And now there's no tax consequence for doing that, no adverse. And now I'm helping this student, this grandchild, go to the college of their choice, something that they may not have been able to do if you didn't take that action, for instance.
Okay. What can the money be used for? Is it tuition only?
It's a number of things. Again, not every expense that you might consider an education expense is a qualified education expense. So that's a good question. The things that it can be used for are tuition and fees, room and board, books and supplies. There's a category called special services, computers and related equipment, and the repayment of student loans. You can use 529s for all of those things, but you have to deduct from those total expenses any amounts you receive from Pell Grants, tax-free scholarships, tax-free employer assistance programs, or from the lifetime learning credit. Some things that people sometimes think would qualify but don't include insurance payments, sports expenses or monthly health club dues, electronics and smartphones, transportation and traveling costs, and room and board in excess of what school housing would cost. So there's some limitations to what it is, but it's kind of the things you would expect to be qualified education expenses typically qualify.
This doesn't mean then, because I heard you mention it, that you're not going to be able to apply for grants or financial aid. Like, how does that work in context with the plan?
Yeah. So if let's say your total expenses for a year were $30,000, you got, some kind of tax-free scholarship money, or you used a lifetime learning credit, and those things totaled up to 10, well, 30 minus 10 is 20. That would be the amount of qualified expenses you could actually distribute from the 529 plan.
So what are some of the drawbacks and considerations we need to keep in mind when using one of these plans?
So there is a small impact on financial aid eligibility. If you think that you're going to qualify for needs-based financial aid through the FAFSA form, it'll be worth exploring whether a 529 contribution will impact your eligibility there. But it's typically a minimal impact. And often the people that are able to make more material 529 contributions aren't too worried about needs-based financial aid. There are also penalties for non-qualified withdrawals, which we did cover already. Those penalties are primarily that 10% penalty tax rate on top of the ordinary income tax rate. That being said, because you have the tax deferral for so many years, if you have that money invested over 10, 15, 20 years for an education that ultimately was overfunded, you may have gotten a tax benefit on the front end at the state level. In Virginia, you're getting 5.75% of a state tax reduction for every dollar that you put in. On the back end, you're paying a 10% penalty, but you've gotten tax deferral for all these years, and there's value in that. Now, I don't have the numbers, but there's some break even depending on how fast the account grew, the fact that you were not having to pay tax on interest and dividend income all those years, and you were fully reinvesting back into the portfolio. There's value there. that offsets potentially some of that 10% penalty tax rate.
Okay, so let's talk about concerns about double dipping. When would that be an issue?
So that would be an issue going back to the lifetime learning credit, going to the American Opportunity Tax Credit. Those are the two primary tax benefits used by people with education expenses. You can't take advantage of that credit and also use the same expenses for 529 withdrawals.
That would be the double dipping you're talking about. If you try to use both, it'd be double dipping.
You can use both in the same year. You just can't use both for the same expenses.
Correct.
What do we do to maximize the benefits of 529 plans?
Well, you're going to obviously want to start early, so you give the account the most time to grow. Helping out family if you're in the grandparent generation, helping out your kids and your grandkids by making those contributions for them when they might not be as easily able to afford to can be a huge help. Again, just because the earlier you get started, the more time it has to compound and benefit from that tax-free growth and tax deferral. Of course, considering professional advice for the strategy you're going to employ may help align the portfolio with the time horizon that the funds are going to be used more appropriately. That can help set the portfolio up for better growth in the early years and maybe be a little more protected when the student is approaching or in their college years and spending the money down. You certainly don't want downside volatility and a bad surprise when you need the money. And then the last thing is to stay up to date about regulations on 529 plans and any changes in the laws.
How often do these laws change? David, how often do you think that this is something that you're going to have to keep an eye on? Is it every year? Is it every couple of years? Is it every 6 months?
As with all tax issues, you just don't know. I mean, it's something that can change from year to year. I mean, there have been pretty big changes with the addition of the ability to do the rollover to the Roth recently, and also the ability to use funds for K through 12 education as well. So now 529 funds can be used for private school educations. So that's something new as well that just came about pretty recently. So both of those are recent changes, and we just don't know when they might tweak this again. You just really have to keep an eye on it each and every year to make sure that these things haven't changed a great deal.
So is there anything that we left out, Caleb? Is there some key points that you want people to take away when it comes to these 529 plans?
So there's one major strategy that we did not cover yet, which is really for estate transfer, wealth transfer for higher net worth families. The Roth rollover option has improved this strategy because we can take some money and put it into a tax-free account later down the road. But remember, you can change the beneficiaries of these assets down the road, and you can change it down the family line to children of your children or grandchildren, which means if you overfund this thing, you may be able to entirely avoid any penalties just by changing the beneficiary. When student A is complete, you pass it down the generational line because there's no requirement that the funds are ever taken out in a certain time period.
Right.
You can use this as almost an education endowment for a higher net worth family to pre-fund generations worth of education costs. Each generation can potentially now take out 5-6 years worth of Roth IRA contributions when they graduate before transferring it to the next generation. And so this, the state tax deduction on the front end, at least in the state of Virginia, the tax deferral over time, the ability to change the beneficiary to someone further down the family line or back to yourself if you need to, gives you a lot of flexibility. It's the only tool that I'm really aware of that you can take money out of your estate through the annual gift exclusion and then later bring it back in if you want to. So if you had a child that you were hopeful would go on the right path, but maybe didn't, you can, again, change that beneficiary to somebody else, which could be yourself down the road if you felt like those funds weren't going to be used in the way you had hoped they would. This idea of using a 529 as a wealth transfer strategy for higher net worth families, it can really be a great tool to get assets out of the estate gradually over time or quickly using that 5-year super funding rule. Try to minimize the taxable estate down the road.
Yeah, the bottom line on 529s is that they are a fantastic tool for all kinds of tax planning when it comes to education, and there are all kinds of gifting within the family. That's the way we sort of think about it. It's a great way to help the next generation. from an educational standpoint. So there's no reason not to overfund. If you can afford to and you're comfortable with it and you want to, overfunding doesn't have any real downside, is what Caleb was just saying, because we can't, because of that ability to transfer the funds around, ability to move the money into Roth, all kinds of positives. So we really do encourage the use of this tool for a variety of reasons, but I mean, it's just a great way to help the next generation out, whether they're your kids or your grandchildren, et cetera.
Yeah, it sounds great. So, David, if people have more questions about these 529 plans, how do they get in touch with you?
Go to our website, rvawealthmanagement.com. You can either schedule a consultation, which is free, or you can get a 20-minute Ask Anything call with me where you can ask anything, just like it sounds. Just get it on the calendar, and you can go right to our website, schedule that to meet your schedule. My calendar's in there, and get your questions answered on this topic.
All right. Well, thank you, Caleb, for joining us today with your wealth of information.
Thank you, Wendy. Thank you, David, for having me on.
All right, guys. Well, thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Unleash Your Retirement podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rvawealthmanagement.com or give us a call at 804-497-2100. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of RVA Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of RVA Wealth Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by RVA Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, RVA Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.